There's definitely a shakeout in process. And the same thing happened actually during the last big commercial real estate downturn in the early 90s. If you look at I saw a slide recently where if you look at the top 10 private equity real estate investment managers in the 90s and compare that to what it was in 2007, basically every slot had changed. So all the big investment managers of the 90s either transformed or were sold or somehow or potentially were no longer in the business. And the big groups earlier this decade were some of the large private equity firms like Blackstone and then some of the large investment banks like Morgan Stanley. What is clear is that the top 10 as of 2 years ago is not going to be the top 10, probably isn't the top 10 today. It's not going to be the top 10 certainly in a couple years. What we're trying to get a sense for is who, and I don't know the answer to the question as to who the new players are going to be in a few years, but there will be new groups that come out of this, potentially groups that spin out from their former employer and start to raise capital, hang out a shingle. So it's hard to say. The business will continue to be a primary method for institutions to invest capital in real estate. As somebody mentioned earlier, the public market isn't big enough to accommodate the amount of capital, institutional capital, that is seeking to invest in U.S. commercial real estate. So those pension funds who generally speaking, have smaller staffs, they don't have the people required to go out and source and manage investments that they make in commercial real estate. They're going to continue to seek to invest with private equity investment managers. Although there's been a lot of talk lately over the last 12 months about how some of these pension funds who have been burned by some of the more aggressive private equity investment managers that invested a whole lot of money at the peak of the capital market cycle in 2006 and 2007, there's been a lot of talk that they're going to retain discretion over their investments going forward, such that the private equity manager can't decide what investment they're going to make. They have to bring those investments to the investor. The investor then approves it and goes out and then they can go out and make the investment. That's in our view at M3, that's a temporary phenomenon. Most of these large state pension funds just don't have the staff to keep up with the amount of requests for capital that'll be coming in to make investments. So we think the discretionary model will come back. It just may take a couple years.
Brad, what do you think the determining factor will be in terms of which private equity funds survive or which ones thrive? Will some be punished because they made investments that ultimately went sour, or will the investors say they're a victim of the market, we're all in the same boat, and continue to invest? What's going to make that determination?
Well, some of them are just exiting the business entirely by nature of the fact that they were part of an investment bank that no longer exists, or part of an investment bank that simply is exiting the business. The groups that made the biggest mistakes, and there are a few poster children for those groups, unfortunately some of whom we worked with, they won't be in the investment management business going forward. I think, though, that anyone who invested capital in real estate over the last 5 years has returns that don't show very well, and so there will be a lot of groups that although their returns don't show well over the last 5 years, will survive. It's just a matter of I guess the degree to which they haven't done well.